This is a brief lesson on initial public offerings, also known as IPOs. We'll cover three things. What is an IPO? Why does a company choose to perform an IPO? And who sets the parameters of an IPO? An IPO is when a privately owned company decides it no longer wants to be private and wants to be publicly traded. The shareholders at that time of the company, which are typically the original founders, any partners, and any venture capitalists, they agree that they no longer want to just hold their shares and are willing to let those shares be invested by the public. The initial date is the first date at which the public is allowed to buy those shares. And that's where the term IPO comes from, as the initial date for public offering. The shares, of course, then have to be available on a public exchange, most commonly the NASDAQ or the New York Stock Exchange. Now, there's a wide variety of reasons why a company would perform an IPO. The most common reason is to raise cash for operations, growth, and expand into new markets. And a good example is if a domestic US company wanted to expand operations into Asia or Europe, by going public, it would be able to generate a large amount of cash to pay for those type of efforts. It's also a way for venture capitalists to receive the equity in return for their initial investment. Most venture capitalists that support and help private companies are supporting them just for that reason, to get them to a public traded status so then they can cash out and benefit from their investment. It's also a common exit strategy for families and the initial owner of the company that is coming to a point to where they can no longer handle the company, is have it publicly traded and a board takes over and is moving out of major operations. Now, typically, it's believed that companies should become public once they're valued around $1 billion, but that's actually not a requirement. A company much smaller, as small as 100 million or 75 million, could decide to be a publicly traded company. And there's been companies that wait to much larger than the 1 billion evaluation before they're public. A good example, probably the most famous example, was Facebook. Facebook's IPO was valued somewhere around $100 billion when it was launched. So who decides the IPO? Well, fortunately for us, the private company does not get to set their initial price. They obviously would set it much higher. An independent investment bank that specializes in underwriting and the sector that the company is opening into performs due diligence, assesses the financial records, and comes up with a fair market value for the company and decides the opening share price for that first day. Once the company has met all the regulatory requirements of the Securities Exchange Commission and registers with an exchange, a date is advertised. There's usually a fair amount of marketing as well that's involved to gain interest. And the date is the date that arrives, and you and I and others in the public are able to buy stock in that company for the first time. This concludes our training on IPOs.